12 trillion. That's how much private equity is projected to manage by 2029. It's a staggering number, but the real story is what's behind it. Firms expanding into infrastructure, secondaries, private credit, and redefining how they build teams, structure the deals, and create value. If you work in or around private equity, this is a moment to pay attention. Explore our private equity content hub for insights, research, and tools to keep you sharp. Visit cfainstitute.org/PE to browse the collection.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we are fortunate to have with us Matt Hougan, Chief Investment Officer of Bitwise Asset Management. Bitwise is a global crypto firm with more than $15 billion in client assets and offering over 30 crypto investment strategies. Prior to joining Bitwise in 2018, Matt was the CEO of ETF.com, where he created the first ETF data ratings and classification systems. He's also the co-author of 2 publications for the CFA Institute Research Foundation, A Comprehensive Guide to Exchange-Traded Funds, and Crypto Assets, the Guide to Bitcoin, Blockchain, and Cryptocurrency for Investment Professionals. Matt, welcome to the podcast today.
Gary, thanks for having me. I'm so glad to be here.
Before we get into this really dynamic sector, can you share with us from a career perspective how your career sort of evolved in the digital asset space over time?
Yeah, probably the right place to start answering that question is with ETFs. Because as you mentioned, I spent about a decade helping build ETF.com with some incredible colleagues like Jim Wyatt, Dave Nottig, and Don Friedman. The thing about ETFs, which people forget now, is that if you go back to the early 2000s, they were a disruptive financial technology that everyone was skeptical of. I can remember Congress having hearings about ETFs destroying the American dream, about Vanguard being reluctant to launch ETFs. So this was a disruptive technology that very many people were skeptical of. But when we looked at it, we saw something that was faster, cheaper, more tax efficient. And so we built a business. And today, ETFs are the dominant way people invest, right? They've taken over for mutual funds. I bring all that context because when I sold ETF.com in 2015 and then did an earnout and looked around for the next wave of my career growth, I was looking to pattern match. What is a disruptive financial technology that makes things faster, cheaper, better, and that is really elegant on the inside, but which society is skeptical of? And boy, was that crypto. If you think people are skeptical of crypto today, in 2017, they were very skeptical of crypto, but it is a really elegant financial tool with massive applications. And so, I pivoted my career there. And the only thing, we can go as far as you want, I'll just say this. Since 2017, I've been surprised positively in 2 ways. I think the growth of crypto has exceeded my expectations. Right, we're at the point today where Larry Fink, CEO of BlackRock, is saying every asset will be tokenized, run on crypto rails. The SEC chair says the same thing. Bitcoin is held by sovereign wealth funds. It's been incredible. And then the second is I'm more impressed with the technology and what it can do today than I was in 2017. So I was sort of made a leap. And what I found out when I made the leap is that the water was actually even nicer than I thought. And I thought it was going to be pretty nice.
And given that deep background you have, sort of as a primer for this discussion, can you distinguish for us between sort of the more significant constituents that compose the Bitwise 10 large cap index and the investment profile, or some of the merits of each of these asset classes? Like, why own one versus the other, essentially?
Yeah, absolutely. I'm going to start with a quick analogy again, and then I'll get into the details. The analogy is to think of the internet. If you go back 20 years ago, everyone knew the internet was going to be a big thing, but there were multiple ways to play it, right? The number one way to play it was to buy Google in search. That was the biggest market and the biggest company. But you could have also have bought Amazon. That was using the internet for retail, or Salesforce. That was using the internet for business to business communications, or Netflix. That was using the internet to stream video. And these all had very different returns. A lot of people look at crypto and just think of it as one thing. But crypto is just like the internet was the ability to move information over computers, crypto is the ability to have property rights and move financial assets over computers. Today, the biggest application of that is Bitcoin, which is really designed to be like digital gold. But there are other things you can do with it. If you take Ethereum, the second largest asset in the Bitwise 10, It's not designed to be digital gold. It's designed to be a platform to move dollars, stocks, bonds, and other financial assets around the world at the speed of light. You can move money on Ethereum faster than you can on JP Morgan. You can trade stocks faster than you can at the New York Stock Exchange. It's a crypto asset because it's built on blockchain, but it's as different from Bitcoin as Amazon is for Google. If you go down the chain, you see more competitors with Ethereum. Solana is a competitor to Ethereum. XRP is a competitor to Ethereum. Cardano is a competitor to Ethereum. Just like, there were a bunch of different competitors to Google. And then there's some interesting DeFi applications and information sources like Chainlink, which is sort of like the Bloomberg of crypto. I raise all that because I think a lot of people just think cryptocurrencies, they're all the same. In fact, they're as different as internet companies. Internet companies were very different. And I'm very excited about Bitcoin. I'm very excited about ETH. I'm very excited about Solana. I'm very excited about Chainlink. That's why I want to just own the basket and own them in a diversified manner.
And you just touched on it really, that, trying to demystify the sector for investors. Do you still think there's some degree of misconceptions out there amongst investment professionals regarding digital assets? And if so, what are those issues?
Yeah, massive. I mean, the first is the word cryptocurrency. You said digital asset, which is much more accurate. Many people still say cryptocurrency. It's like the original sin of crypto was to use that term because, of course, even I don't use Bitcoin to buy coffee. That doesn't mean it's not useful. So I think thinking of it as digital assets and this sort of like internet of money instead of a new way of using currency, I think is a big misconception. The other one we see is that people have what I call anchoring bias. Maybe they first heard about crypto in 2013 when it was hard to store it and the network was a little bit shaky and there was a lot of criminal activity and they assume those things are true today. That's not crypto today, right? Crypto today, you can custody crypto assets at the largest, at $100 billion companies that have insurance from Lloyd's of London. You can trade crypto assets with Jane Street and Citadel, the largest institutional market makers in the world. Crypto now has AML KYC on all digital asset service providers. So the share of criminal activity has almost vanished out of the crypto network. It's held by the largest institutions in the world. So I think a lot of the misconceptions aren't really misconceptions. They're just out of date. Crypto in 2015 is not crypto in 2025. And I think the challenge we have as an asset manager is to get people to update their priors and look at this. Because if you looked at it now with new eyes, you would see an institutional emerging asset class. And that's really what we try to get people to do.
And even with all the education you're doing, which is great, there's still the cryptocurrencies continue to perform extremely well. Can you share with us why that is? And do you think that's sustainable into 2026? And are there particular catalysts we should be focused on?
Yeah, there's the old saying that to do really well in investing, you have to be non-consensus and right. If you're consensus and right, you get the market return. If you're wrong, consensus or not, you did crushed. I think the reason crypto has been performing very well is that it's non-consensus, but it appears to be right. It appears to be the case that Bitcoin will eventually stand side by side with gold. And that means what's a $2.5 trillion asset is going after a $25 trillion market. It appears to be the case that stable coins and tokenization will be multi-trillion-dollar markets, right? That is what major institutions are orienting to. But the market doesn't realize that, so it's non-consensus. I think another way to think of it is take something like Bitcoin. Today, 95% of all the Bitcoin that will ever exist in the world is owned by somebody. And 95% of investors have no exposure to Bitcoin. As those 95% of investors try to get into the market, what happens is the price goes up because they have to convince existing people to sell. And that may be confusing for people, but that's just what's going on. It's been the best performing asset for the last 3, 5, 10, and 15 years. And I think it still has plenty of room to run.
Right. Which touches really leads to another question, really. How should investors think about, valuing these digital assets, and does it vary by asset class?
It varies by asset a great deal. So you take something like Bitcoin, Bitcoin doesn't produce cash flow. The best way to value Bitcoin is to think about what markets it's aiming to disrupt. Let's say it's just trying to disrupt the gold market, and then asking yourself, how much of that market will it take? Today, the gold market's worth about $25 trillion and Bitcoin's worth 2.5. So it's taken roughly 10%. If you think that store value market will double to 50 million and Bitcoin will go from 10% to 20%, right? All of a sudden, you're talking about a $10 trillion asset. That means the asset will go up 4x if that's your thought process. So that's the way to think about that. These other assets like Ethereum and Solana, they're actually driven by cash flow, believe it or not. So Solana, there's about $2.5 billion in annual revenue on the Solana network. You can think of it as a software company that's doing $2.5 billion in ARR and growing very fast. What is that worth? It's worth about what a traditional software company that 2.5 billion of ARR and growing very fast would be worth. Today it's about $100 billion. So I do think you can do that kind of cash flow analysis for everything except for Bitcoin. Bitcoin, you really have to value in much the same way you value gold, which is this hedge against fiat debasement. It sort of stands alone.
And when you think about traditional assets like gold, treasuries, or stocks, how do you interpret Bitcoin's behavior? Are there any patterns or correlation yet to emerge, takeaways, really what's an emerging asset class?
Yeah, it has a low correlation to everything if you look at periods longer than 90 days. So if you look since Bitcoin launched in 2009, it's effectively never had a correlation above zero point 0.5 if you were looking at 90-day correlations. And 0.5, of course, is the dividing line between low and medium. Right now, it's about 0.35, 0.4. So it has a low correlation. And for what it's worth, Gary, that makes sense. If I ask you what drives the price of Ford stock and what drives the price of Bitcoin, you would probably tell me that they're very different. And so you would expect the correlation to be low. Now, there is this perception in the market that the correlation is higher. That comes from the fact that on big down days in the equity market, with the NASDAQ 100, for instance, falls 3%. On those days, more likely than not, Bitcoin will fall as well. But what the data shows is that if you hold it, it recovers faster and further. So if you look at like 90-day correlations, the correlation is consistently low. I think that's not commonly understood because the media focuses on those big down days. But of course, as investors, we hold assets for a long period of time, we rebalance, and the data suggests it's just a low correlated asset.
What about, sort of relative value? I mean, when you have stocks, there's often some kind of value trade when there's a discount between one sector or one company versus another that is sort of peers. Is that the case in crypto as well, that there's sort of a relative value play between certain crypto assets and any rules of thumb to think about there?
Yeah, absolutely. So I think the relative valuations people think of are Bitcoin to gold, and that's like a relative valuation play. And then within the rest of crypto, people look at Ethereum as the leader and look at everything else as a fraction of Ethereum. And when you're evaluating like the probability of success of an asset, let's say like Solana, you want to compare how much is the transaction activity? What is the revenue activity? What are these other sort of fundamental metrics versus Ethereum? And then does the valuation make sense? So for instance, Solana is about 1/5 the size of Ethereum. Does that make sense when you look at the underlying fundamentals? The answer to that is that it depends right now on which fundamental you look at. If you look at revenue, Solana should be higher. If you look at share of the stablecoin market, it should be lower. And it ends up somewhere in the middle. But it's actually a rational sitting point on a relative valuation because you can't just look at one statistic. You have to look at an aggregate, and then you can apply it.
And beyond valuation, in constructing the investor mosaic here, any other suggested data points or indicators that we should focus on as investors?
Yeah. So, I mean, look, in terms of what to own, I'm a big fan of the Jack Bogle comment. Don't look for the needle in the haystack, just buy the haystack. I study this 24/7, 365. If you ask me, what is my highest conviction bet in crypto? It's that crypto will be more important in 10 years than it is today. And if that's your highest conviction bet, why not just own the basket? Like, why get lost chasing Solana, Cardano, XRP versus Ethereum? Who knows? I have an opinion, but you shouldn't invest based on my opinion. Just own the basket. People who really want to dig into it, I would say that there are two things to look for in crypto outside of Bitcoin. You want to see a high quality project from a technical perspective, That means fast technology, high developer activity, large number of users. And then you also want to see an entity with a network effect, with a strong community and a lot of people participating in it. One mistake I find traditional investors who come into crypto make is to look for the blockchain with the best technical throughput and ignore the network effects. And I would just remind people my age and older to think back to like Betamax versus VHS, right? Betamax was better technology, but lost out on the network effect side. And that can happen in crypto too. The network effect is so obvious. Like, oh, Ethereum is big. Lots of people are on Ethereum. You can't imagine that that's important. That's actually as important as how fast and technologically advanced this blockchain is. I can build the coolest widget in the world. And if no one is using it, no one is using it. And I think just keep those two things in mind, sort of the network effect in the community and the quality of the technology and developer activity. When those collide, you get spectacular returns in crypto.
What about macro factors, things like inflation, interest rates? Do they fit very much into the investment picture for this asset class?
Yeah, this is a growth asset and a risky asset. So all else equal, lower interest rates are better for this asset. In the same way they're better for other growth stocks. High economic growth is better for this asset. Even Bitcoin, which is like a version of digital gold, people think, well, that should be a hedge, but it's a risky version of digital gold, right? Like it's an emergent version of digital gold. So it trades more like a risk asset. So if you think of the things that benefit risk assets in the short term, those benefit crypto as well. You want sound macro conditions with good economic growth and lower interest rates, all else equal. In the short term, that's helpful for crypto.
And shifting into portfolio construction and products, what are you hearing from institutional investors today? How does that differ from, say, 2 or 3 years ago?
Yeah, there are two big changes. The first is that many have gotten off of zero. I think 2 years ago, before the launch of Bitcoin ETFs, it was easy to say, I just can't access this class. I can't trust it. It doesn't have the regulatory approval. And most institutions prohibited it. Now it's becoming relatively common for institutions to have small allocations, whether that's the Harvard Endowment or MIT's endowment or the Luxembourg Sovereign Wealth Fund or Abu Dhabi Sovereign Wealth Fund or an advisor at Merrill or Wells Fargo or an RIA. It's now normal to be off zero. The other big change is that the allocation starting size has increased from about 1%, which I think of as a token allocation, to now we regularly see 2.5 to 5, and sometimes they're starting to see 10. So I think before the ETF, people sort of wanted to check the box. Yeah, I have a little crypto exposure, but make it so small that it didn't really matter. 1% was that nominal amount. And now they're like, how do I maximally impact my Sharpe ratio, which is, around the 5% level. And we're seeing more allocations up in that space.
So is it sort of more of a portfolio diversifier today, but potential to be sort of an alternative growth engine? Is that fair to say?
That is precisely extremely well said. Yeah.
And for investor conversations to evolve further, what things need to happen to make cryptocurrencies or digital assets a more established part of institutional portfolios?
Yeah, the biggest thing is the passage of time and the continuing of education. I think it's almost going to happen naturally. There's even a demographic push in that direction. The other thing that I think is going to happen, which will surprise people over the next 3 years, is that they're going to start to use crypto applications in their day-to-day lives. They're going to start to use things like stable coins in their day-to-day lives. They're going to start to do things like trade tokenized stocks in their day-to-day lives. And I think as they start interacting with this space, I think it'll be more comfortable to invest in this space. An analogy there that may make sense is AI was interesting before ChatGPT, but no one had interacted with AI unless you were a cutting edge researcher for 25 years. Once I was using ChatGPT in my daily life, boy, did I want to invest in OpenAI and the hyperscalers. And I think once you're using stable coins or tokenized stocks in your day-to-day life or DeFi applications, you realize how elegant they are and you'll want to invest. And I suspect that's going to be when we really move up that exponential adoption curve.
And does that imply that people or yourselves or people would move out of sort of an index approach into individual asset classes?
No, I still think look, we index everything. I have views about stocks, but most of my investments are in index funds. I have views about bonds, but most of my investments are in index products. I think most people will do a core and explore model where the core is an index-based diversified exposure. And then maybe they're very excited about tokenization and they want to own Ondo. Or maybe they're very excited about layer ones and they like Solana's technical infrastructure, so they want to own Solana. I think you'll see that kind of core and explore approach be fairly common in the crypto space.
And Bitwise has a wide collection of ETFs. How has ETF adoption altered liquidity, investor behavior in crypto markets? And what's the next logical step for these ETFs?
Yeah, it's been massive. Again, the Bitcoin ETF launched in January 2024. It was the most successful ETF launch of all time. So out of 8,850 ETFs, the Bitcoin ETFs were the most successful ETF launch of all time. We just launched a Solana ETF out of 850 ETF launches this year. It's been the most successful, and it's only on day 3 as we record this. So there's been huge investor appetite. My prediction for what's next is actually we're going to see flows accelerate on these ETFs. So I know they've done a lot to pull things in, but my history of people investing in crypto is the first time they invest, they don't invest 100% of what they'll eventually own. They double down over time. And you start to get approvals on platforms like Morgan Stanley. So I think there'll be significant flows. And then the last thing is we haven't really seen the index boom. We've seen Bitcoin, we've seen Ethereum, we've seen Solana. Bitwise has the largest crypto index fund in the world. It's applied to become an ETF. It's not yet an ETF, but I suspect it will be at some point. And when that happens, I think that could be a 10, 20, $50 billion market. And I think it'd be one of the dominant ways people gain exposure. So that's coming in ETF land soon.
And tokenization. How do you see tokenization of real world assets fitting into institutional portfolios in the next few years?
Yeah, look, Paul Atkins, the chair of the SEC, described it as the biggest change in how financial markets work since we went from floor based trading to digital based trading. So, as strange as it seems right now, to imagine a world where we traded stocks in teenies and not pennies, and you had to buy round lots, and then it take 2 days to settle, all that seems absurd here in today's day and age. I think that's how we'll look on the existing market infrastructure. So I think in a short period of time, like 5 years, most assets will be tokenized. Most assets will be trading 24/7, 365. Most investors will have access to a wide array of global assets. What that should mean from an investor perspective is I would want to invest in that theme. I think that theme is a big emergent theme that's underestimated. Again, you have the chairman of the SEC saying this is the direction of travel. BlackRock's CEO said all assets will be tokenized faster than people think. He said that in the most recent earnings call. That's pretty good signal, right? Those are not crypto crazies. That's the SEC and BlackRock saying this is where we're going. So as an investor, I would just want to gain exposure to the platforms that provide the infrastructure for that tokenization, because I think those are going to be a very exciting place to be.
Any other financial products in the pipelines worth digging into today that aren't out there, but sort of could be out there in the future?
Yeah, look, I think one thing that you'll see increasingly in the future is ETFs that combine crypto asset exposure and equity exposure. We sort of exist in this false binary world where our stocks are on this side and Ethereum is on this side. And that doesn't have to be the case. I think you'll see people pair those together. For instance, to give you an example, Bitwise doesn't have this filing, but somebody will. We talk a lot about the Mag 7. I think it's actually a Mag 10. I think it's the Mag 7 plus Bitcoin, Ethereum, and Solana. Bitcoin, Ethereum, and Solana are three of the fastest growing startups of all time. Bitcoin's a $2.5 trillion asset. It belongs in the Mag 7. But we have this artificial divide that keeps them on separate sides of the pie. I think you're going to see a lot of products that put them together. And people are just going to invest across companies and crypto assets like they were the same thing. I think that's where the future is going.
You touched on an interesting point there. I mean, how do you think about, look at the S&P 500 today, it's largely seven stocks as far as contributing. Now we're speaking to digital assets being a component of that. Is that this the future of how investing is going to look, that this index is going to be heavily weighted towards one sector? or is that just a moment in time for that sector, do you think?
Oh, look, I think technology, I'm better or worse. I'm not making a comment on society, just observing. I think technology is naturally a concentrating market where network effects are really important. So I know people hate to hear this, but I think the big will get bigger. But I do think it'll be a mix of stocks and crypto assets that like the corporate structuring is almost irrelevant from an investor perspective. It's like, what's the best return? Um, yeah, the fastest growing startup in the world right now, last 15 years, it's not OpenAI, it's actually Bitcoin, right? Bitcoin's $2.5 trillion. OpenAI is talking about $1 trillion valuation. It's actually Bitcoin. So I think people will start to realize that. But yeah, for better or worse, I think it's probably the direction of travel is more centralization on large cap names, not less.
And moving into some of the industry trends, how would you distinguish U.S. markets for digital assets versus international?
Yeah, well, international, it varies by region. As an example, the Middle East is very aggressive, very forward thinking. Places like Singapore are very aggressive, very forward thinking. They're ahead of the US, and a lot of the industry has moved there. The US was way behind, but with the new SEC, new CFTC, new Fed, new regulatory environment, it's catching up quickly. It's now ahead of where Europe is. You can do more creative things. Europe is falling increasingly behind in terms of even adoption of things like stablecoins. I actually think they're putting their economy at pretty significant risk. So it varies by region. They're all moving in the direction of crypto, so they're all trying to put it more central. But you're seeing, yeah, real leadership in places like Singapore and the Middle East, the U.S. catching up, and then Europe falling behind. Japan has recently sort of made the switch that the US made to being very pro crypto and pro stablecoins. And I think you're going to see that market catch up as well. So they're all moving, they're just moving in different rates.
Another interesting emerging trend is public companies putting digital assets on their balance sheets. What kind of companies are doing this today, and what's motivating them to do it?
Yeah, there are probably three groups. They're worth differentiating them. So one is just big companies that buy Bitcoin instead of buying US treasuries because they want a diversified exposure. So an example is a company like Square or a company like Tesla that holds Bitcoin, or a company like Figma that holds Bitcoin as a portion of their reserves. And I think that's going to continue for a long time, right? I think more and more S&P 500 companies are not going to be Bitcoin focused, but they're going to have some Bitcoin, going to have some crypto. The next, I would say, are companies that I think you're pointing to, like MicroStrategy, that basically exists to hold Bitcoin on their balance sheet. And there are really two versions there. There are ones that are trying to make a quick buck because the market was rewarding that for a while. I think those will go away. And then there are ones that are buying Bitcoin and are going to do interesting things with it. So maybe they're going to lend it out. Maybe they're going to create financial structured products around it. They're like Bitcoin permanent capital vehicles. I would put MicroStrategy in that category. And I think those have the possibility to do quite well. Investors sort of lump all these together. Like any industry, there can be good treasury companies and bad treasury companies. I think the good ones will trade at a premium to their treasury assets, and the bad ones will trade at a sharp discount and eventually go out of business. And we're going to see both in the coming markets.
Another potential catalyst would seem to be regulatory. How would you characterize the current regulatory environment, and what priorities still need to be addressed to unlock the next phase of institutional adoption?
Yeah, real progress. So 2 years ago, we faced a gale force regulatory headwind. It was hard to do anything in crypto. Every major crypto firm was sued by the SEC. There was no regulatory clarity at all. There were no crypto pieces of legislation. That has switched from a gale force headwind to a gale force tailwind. The SEC dropped all of its lawsuits. It's engaging with the industry. As I mentioned, the chairman wants to see all assets move onto blockchain. And we have seen Congress move forward on regulation. Congress passed the Genius Act, which made payment oriented stablecoins legal in the US. A lot of people ask me, why weren't merchants accepting stablecoins? Because before the Genius Act, they didn't know if they'd be violating AML KYC rules by doing so. There's no way Amazon is going to accept stablecoins until there's regulatory clarity. Now there is. The sort of next piece of the puzzle, the most important piece of the puzzle, Congress is wrestling with something called the Clarity Act. The Clarity Act provides fundamental decision making on how crypto is regulated in the US. Right now, we don't even know if most crypto assets are regulated by the SEC or the CFTC. That creates a real depression in terms of entrepreneurs being able to build in this space because you don't know what's over the legal line or what's inside the lines. If that gets through Congress, which I suspect it will in the next 6 months, there's strong bipartisan support for it. I think you're going to see a real flowering of activity, and particularly you're going to see large Wall Street firms building aggressively in crypto because they've just been waiting for the green light, and that legislation will be the green light they can move aggressively. So that's one to look out for.
And Wall Street, you just touched on it. The financiers of any industry, venture capital, private equity, where are they placing their bets? Is it on infrastructure, tokenization?
All of it. They're coming in. They're coming in hot. M&A activity is through the roof. IPO activity is through the roof. They are doing a lot on the infrastructure side, but they're also launching consumer-facing products. Right? PayPal launched a stablecoin. Wells Fargo launched a stablecoin. Robinhood launched its own blockchain and is moving to tokenize all assets. So it's just a giant wave. I do think the right analogy is the internet maybe in the early 2000s. It's not, importantly to your question of infrastructure, it's not the internet boom of the late 90s, which was an infrastructure boom, right? Global crossing and all these fiber optic wires. That's already happened in crypto. The fiber optic wires are already there. The blockchains are already really robust. It's more like that boom in 2004, 2005, 2006, when every company transitioned into the internet. I think every Wall Street bank and brokerage is going to become a crypto company in the same that every bank, every company is now an internet company, has a website. They're all going to move into this space.
And artificial intelligence, a topic, a mainstay really of any discussion. What role do you see AI having in the world of digital assets, particularly in regard to portfolio construction and how Bitwise will manage its business going forward?
Yeah, I think it's going to be huge. To say something obvious, the best technological breakthrough combines breakthroughs in two fields, right? You take social media and then iPhones with cameras, and you get Instagram, right? You take iPhone with GPS, and an iPhone in every hand, and you create Uber. It's that collision. What I see from AI is AI and digital first payments infrastructure are going to create massive opportunities. If you have an AI agent, is it going to walk down to the local JP Morgan branch and open a bank account? Or is it going to use a digital bank account with digital native currency that's just a series of numbers? Of course, it's going to do the digital equivalent, and all of that is built on crypto. So if you think AI and AI agents are going to be important, the way they're going to interact with the world is through crypto-based financial rails, not through traditional rails. And for that, that means to us that products focused on stablecoins, tokenization, et cetera, are really important. It means for us as an asset manager, we're going to need to build on-chain asset management services. It's not going to be enough for us to do ETFs. We have to do tokenized funds as well to be able to participate in where the market is going. So we're moving in that direction as a company. We have a big on-chain business that's growing, and you can expect us to do more and more there.
We've certainly covered a lot of territory here today. When you look further out, what do you think will surprise the investment community the most about digital assets, crypto markets over the next 3 to 5 years?
Yeah, I think it's that the pace of adoption will be faster than people think. The thing about exponential growth is it looks pretty slow until it really gets up the curve. So, as an example, 5 years ago, there was maybe one endowment that invested in crypto. 3 years ago, it was four. Today, there are probably 20 or 30. It means there'll be 100, and then it means there'll be 1,000. So I really think it's on an exponential adoption curve. And I think people think it's on a linear adoption curve. And I think as they realize it's that exponential curve, they'll be surprised at how soon it will be in their portfolios. They'll be surprised at how soon they're paying with stable coins. They'll be surprised at how soon they're trading tokenized stocks because people are inclined to think linearly and crypto is moving exponentially. And I think that is what's going to catch people off guard.
And lastly, for those of us new to cryptocurrencies, digital assets from an investment perspective, what needs to be on their sort of homework assignment or checklist to sort of get comfortable with investing in this space, do you think?
Yeah, I think understanding the asset class is first and foremost. That's why I wrote that paper for the CFA Research Institute in 2019. It still stands up pretty well today, so understand it. And then the two things I would say from an investment perspective, or maybe I'll just boil it down to one thing. Look, I think the biggest risk in crypto is behavioral risk from investors. So the biggest risk, this is the best performing asset class in the world over the last 10 years. But it was easy to miss out even if you invested, because let's say you invested and it pulled back 20% and you sold and you never looked at it again. That's the biggest risk that you encounter. I don't think there's much risk from a technological perspective. I don't think there's much risk from an adoption perspective, but there's huge behavioral risk. How do you control for that? You control for that by position sizing. If it's 1, 2, 3, 4, 5% of your portfolio, you're not going to get spooked out. You control for it by dollar cost averaging. You control for it by rebalancing. All the tools we use in every other area of the market, position sizing, dollar cost averaging, rebalancing, are actually extra important in crypto. And so I would just keep that behavioral element in mind as you start to think about this market. Don't go all in at once, get scared, and then never touch it again. You'll miss out on one of the greatest investment opportunities, I think, of our lifetime.
Matt, thank you for joining us, sharing your wealth of knowledge and your highly value-added perspective of this emerging and dynamic sector. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance, and we'll see you again soon.